In light of the Fed's recent signalling of a pause in the tightening cycle, we thought we'd have a look at previous end of Fed funds hiking cycles, or indeed pauses, and have a look at the impact on various markets, on growth, and the S&P 500 in particular. So if we first just consider what is happening in the Fed funds market, and looking at how the market has moved in terms of its pricing of Fed hikes going forward. On this chart, we're showing the Fed funds rate, but also showing the blue line, which is the December FOMC projection. So you can still see that's heading up over 3% by 2021. The dotted line in this instance represents the market positioning as of late September, which was also expecting further tightenings up to around about 2.9%. And the pink line there that I'm highlighting is the most recent market implied expectations, which essentially has Fed policy on hold, as you can see here, through 2019, with the prospect of a modest easing, more likely than a tightening during 2020. So quite a significant change that has occurred. So if we now look at previous end of Fed tightening cycles or pauses. And so what we're going to have a look at here, so we've identified these as being those previous periods. So in 1995, 97, 99, 2000, 2006, the pause at the end of 2015, and then this most recent instance. So in terms of what's happened to the Fed funds rate, as we look here, this is now showing the 12 months pre and the 24 months post the beginning of a pause or an end to the cycle. Typically, rates have stayed on hold for around about 12 months. We've seen here on a few occasions. There has been an occasion where an easing has occurred earlier, and that was in 1995. So that's sort of where we're sitting at the moment. What about for bond yields? What's happened to bond yields previously? And I think this is sort of interesting to look at. And of course, that we've been, this has all happened against a backdrop of a declining trend in 10-year bond yields. But suffice to say, the end of Fed tightening or potential pauses in Fed tightening have seen quite significant rallies in bond yields. As you can see here, the average is the dotted red line. So after a 6-month period, the average rally has been about 70 basis points. By around about 10 to 12 months, it's been something like 100 basis points. Obviously, there's a range within that, but clearly has been a very positive period for bond markets and declining bond yields. In the current experience or occurrence, bonds have started falling prior to what we've determined to be the Fed pause. Markets were starting to build that in a little bit earlier, so you could say that bond markets have rallied about 40 basis points, so a fair way there already. Now, what about for yield curves? If we look at the 10s minus 3s, 3-month, so the yield curve has typically been flat really in this on this basis at the time of the beginning of the pause, and has actually gone increasingly inverse over the following 6 months. That has been the pattern on the past 5 end of cycle or pauses. Looking at the US dollar, what has happened to the US dollar? It's been quite mixed, you'd have to say. On average, you've seen a rise in the US dollar leading into the pause, and then pretty much on balance, a sort of a sideways movement in the US dollar over the following 6 months. If we now step down and look at some of the activity indicators, the ISM index, I will put that in original terms. So the ISM index, if we take the average of each of these occasions, it's slowed from around about 53 to an average around about 49. Obviously, once again, a wide variety of outcomes over the sort of the 9-month period, where in the case of 2000, the ISM had fallen into the low 40s, whereas in the case of 97, it was still up around about 54. But on average, you've seen a decline, certainly over the first 6 months before some sort of stabilization. Now we look at earnings growth, what's happened to earnings growth during these periods, and that is here, express that in percentage terms. So earnings growth, the rate of earnings growth has slowed, sort of 15% on average growth leading in to the end of the tightening cycle or the beginning of the pause, more often than not, earnings growth has continued to increase and started to roll over after about 6 months, 6 to 9 months in. Probably now focusing in on valuations. And if we look at the PE, we'll look at it in original terms. Actually, we'll look at it in percentage terms, percentage change. So the PE on 4 of the 5 occasions, the valuation has actually increased by around about 5%. There's one occasion where it's actually declined, and that again was in 2000. So more often than not, the PE or the forward PE has increased. And as we saw earlier on, forward earnings growth has also, been modestly rising, although at a slower pace. So if we now look at the equity market itself, the S&P 500, at the there's 0, as I said, marking the beginning of the end of the tightening cycle or a pause. And the market on average has risen by around about 8% over the first 6 months, and by something like 15-17% over a 12-month period. Once again, quite a variety of outcomes, particularly notice the divergence between the 2000 experience and the 1997 experience, where the market rose another 45%. So that probably doesn't give you a lot of information. There's a variety of outcomes, but perhaps we can look at the stage of the cycle and see whether that might have any impact. But before we do that, let's just if we remove the 2000 experience, so as you can see there, the market on average has done quite well over a 6-month period. First 6 months into a pause or end to the cycle, the market has increased by about around about 10%, a little bit over. After 12 months, it's done a little bit over 25% with that sort of range there. So generally been positive for markets. But what might be interesting is to look at where we are in the economic cycle. And I'm using the NAIRU output gap in this instance. And let's just put 2000 back on the chart. So these are the periods. So potential end to a tightening cycle here. Back in 2015, we'd see that as a pause. It was quite early on in the cycle. The unemployment rate was still above NAIRU to the tune of about 50 basis points. In 2006, the economy arguably was operating above capacity, about 40 bips below NAIRU. Likewise, well above capacity, so well below NAIRU in 1999-2000, and these earlier 1997-95 were probably seen as just operating in line with potential. So arguably earlier in the cycle. So comparing like with like, perhaps this current pause, if you like, in the Fed funds has more similarities with the 2006 and the 1999 cycle. So let's have a look at the equity market in those examples. So we're going to remove the sort of the mid-cycle pauses and just focus on the others. So on the other two, which is May 2000, as we already said, quite a poor outcome that followed for equity markets. Equity market over the next 12 months was off 12% and eventually off something like 25%, whereas in the case of 2006, the market kept rising for another 12 to 15 months, up something like 20% over that period. So two quite stark experiences in the following 6 and 12 months for what we sort of see as sort of similar stages in the cycle, being that is quite late in the cycle. So what's the more likely path, or what does the current situation have in common with each of those two quite varied pathways? The 2000 pathway, which was quite a very poor following period for US equity markets, as opposed to 2006, which certainly in the following 12 months was still a positive environment. So if we just go through some of the indicators we looked at earlier on, the first one we'll look at is an ISM index, and what we see here, black line is the current situation. So here we are sitting, let's put that in original terms. Here we are sitting at about 54, coming down from the high 50s. In the 2000 example, the ISM fell away quite sharply from the current level of around about 53 at the time, down to the low 40s. So it was that poor equity market performance also coincided with very poor ISM activity readings, whereas in the 2006 example, the economy slowed, but only back to around about the 50 to 51 level. What about earnings growth? If we look at, we're just looking at trailing reported earnings. And I suppose what one might have expected, earnings continued to rise by something like 10% EPS over the following 10 to 12 months. In the 2006 example, that's the example where the equity market kept rising at the end of the Fed tightening cycle, whereas in the case of in 2000, it fell away quite sharply. Earnings fell away, as did ISM readings. US dollar performance was also quite different. In 2000, the US dollar actually continued to rise, which would have been a negative to some extent for the US earnings, while in 2006 the US dollar was actually falling over that period. And what about valuations or starting point valuations? Well, if we just look at that in original terms, starting point valuation in May 2000 was around about 23 times forward earnings, whereas in 2006 it was a much more friendly sort of 14 and a half times forward earnings. So, when we look at the comparison between a similar late cycle pauses, 2006 and 2000, we probably find more similarities with the 2006, although as we know that eventually ended in quite substantial downturns. Thank you.